So what I've done is I've taken 106 slides to cover this topic, but that 106 slides is not for the purpose of discussion. So many things, you need to refer to the different literature. So I thought some of them with the reference point and to the punchline I will cover here, so that this becomes the standalone material for the purpose of homework and studies after the session is over for all the time to come. Except that you may have to update it for changes which may be carried out by the tax on the trust laws. So I've divided my presentation for today's in 4 parts. First, the trust law. What is the regulatory aspect of the trust law? Then what is the taxation of the trust? How the taxation of the trust is devised in the onshore jurisdiction and the offshore jurisdiction. Then the third part is how the Indian tax system is devised to handle the taxation of the beneficiaries or the taxation of the trust per se. And then lastly, I thought, as Bharat has requested me to cover the FEMA aspect of a trust. So there probably we will have 5 or 6 slides to discuss. And there are about 20 slides on FEMA. This is just to explain the background if someone is supposed to understand the law as to the basics of the FEMA as applicable to the trust transactions. Also, in order to complete the sequence of understanding, most of the issues I've explained from the standpoint of the life cycle of the trust, that how the trust is created first. Okay, there's a creation of the trust, then there is the income of the trust, then there is a distribution from the trust, and there's a closure of the trust. So each transaction I have taken from this cycle, life cycle of the trust standpoint of view, So coming to the overview of my presentation, which is appearing on slide number 2, what is the concept of the trust that we will explain? What is the uses for which this trust are employed? And then what is the taxation of the offshore and onshore trust? And how this system of taxation is linked to the taxpayers, which we are popularly knowing is the connecting factors. Then how each country is taxing the trust differently. Somebody is trying to tax it from the perspective of settler. Somebody will say, no, I want to tax only beneficiaries. And somebody say, no, only trustees are responsible for the making payment of the taxes. But thereafter, comparing the world with the India, I have considered the provisions of the Income Tax Act, how the Indian trust or the trust in India, not only Indian trust in India is taxed. Then I've covered the important judicial precedents to understand the concept more clearly. And then took a case study of the offshore trust with resident beneficiaries and the resident trustees as an option. And then taken the FEMA, that how this transaction of the trust, like creation of the trust by creation of the trust affects the FEMA. Because you could have an Indian trust with the non-resident beneficiaries or the non-resident settler. Similarly, you may have the foreign trust with the Indian resident as a settler and Indian resident as a beneficiaries. So therefore, the trust cannot be judged, or its tax system cannot only consider the formation of the trust being in India only as a background for taxing the income of the trust. So therefore, I have covered the case studies of a cross-border transaction trust. I have not covered the case studies for the Indian trust, or where all the beneficiaries are the Indian resident. That I have not covered as a case study. But since I have covered the complete jurisprudence in the life cycle of the trust transaction vis-a-vis the Income Tax Act, I thought the case study may be considered for the purpose of the cross-border transaction only. So with that, let me go to the Indian Trust Act 1882. It has these many headings and the chapters. What are the provisions of creation of trust? What are the duties of trustees, rights of the trustees, disability of the trustees, then the rights and liabilities of the beneficiaries, how trustees will retire, how trust can be closed, and what are certain obligations where whether you call it as or not, it becomes a trust. So these are not formally formed as a trust, but those obligations are also found in the sections of the Indian Trust Act 1882. Now we go to the technical materials proper and understand what is the definition of trust. See, the question arises to our tax consultants and the lawyer's mind whether the trust is in the nature of an entity or what is a trust. So, if you see the definition of trust over the global area in various jurisdictions, the common definition I've found is an equitable obligation binding a person to deal with property over which he has a control. So there are 3 or 4 parts. So the trust is an equitable obligation, and this obligation is annexed over the property, and this obligation is binding the person who has a control over it, namely a trustee, who could be also responsible to the various beneficiaries, which may include himself. And therefore, in these 5 parts, the trust obligation is being structured. So, what is a trust? We will come to little later, whether it is an entity, whether it is a person, and how do you deal with such a arrangement under the tax law. And under the Indian Trust Act 1882, a trust is defined as an obligation annexed to the ownership of property and arising out of a confidence reposed in and accepted by the owner, that is settler, or declared and accepted by him. Declared and accepted by him, the settler may be a trustee himself, for the benefit of another or of another and the owner. That means it's a settler who is giving the properties to himself as a trustee, and he is holding this property for some other people, including himself. So that means what he says is property can be given by somebody who is the owner of the property. It can be given to himself as a trustee or to somebody else as a trustee, and it is held by the trustee for the benefit of others, others are known as beneficiaries, and those beneficiaries could be settler himself. That's what the law of trust says. Now, what is the purpose of this trust? Probably just before we go to the purpose of trust, as we've seen, there are 1, 2, and 3 elements. The element who is an owner is called a settler in the trust. The trustee who has been entrusted with the object of the trust and who is the holder of the property. And there is a third agency called beneficiaries. These assets which are held by the trustees are for the purpose of and for the benefits of the beneficiaries. So there are 3 agencies: settler, trustees, and the beneficiaries. And therefore, we look at the trust as a dual ownership concept. And how the trust law has evolved, it's a long history and has evolved from the England, when the king wanted to give his land for the purpose of cultivation to various of his population, farmers, and used to enter into an arrangement that this land is being given to you for use and not transferred to you. So when an asset is given to you for use for the benefit of either the farmer or his family, then the arrangement was an unwritten arrangement by the king an oral understanding by the king with his fellow citizens. And that is how this trust has come into place. And then the law has evolved, and then law has been employed for the purpose of various of its uses, which are fitting with the legal framework of the trust law. Then the business entrepreneurs, the king, the 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 owner of assets who is retiring, all of them thought that these particular provisions of the trust and the arrangement in which it is structured could be made to use so that his wishes are fulfilled. So, what are the number of uses? The number one use which people are using is for succession planning. You all know that the popular tool we all use is the will for the succession planning. But we also know that will comes into effect or it triggers the execution only after the death of a owner of the assets. Whereas trust is created by a living person during his lifetime. And therefore, the assets are transferred during the lifetime and it also operates after the lifetime. So once the trust, which is known to have operated after the lifetime only, it is nothing but a will. A trust deed made during the lifetime of the settler and it is supposed to operate only after his lifetime is nothing but merely a will only. So that is the difference between the will and the trust. And of late, the concept of succession planning is if you want to give away your assets to various relatives or your inheritors after your death, why not give during the lifetime? And why not to avoid any kind of emergency situation that you have to create a will or arrangement in the last moment. And also, a lot of procedural aspect of probate, court process can be avoided if you do succession planning through a trust, which is called a living will. So then the similar use are put by the number of entrepreneurs where they are only managing the assets of third parties for the benefits of all the third parties, including themselves. We know popularly the venture capital fund where carry structure and the capital gains sharing is made with the various investors, where the managers have no interest in the fund, but they have interest in managing it and earning the rewards as may be agreed by them with the trust. So therefore, the finance industry, venture capital fund, private equity have, and the wealth management. Wealth management is nothing but again, succession planning, etc. And also today, number of industrial family have used trust as a structure to perpetuate their business, even if the next generation is not interested in running the business generation to generation. And the name of the trust or the type of the trust are generally have derived their nomenclature from the function to which it is put to. If there is an asset protection trust, it may be said as accumulation trust. If it is a purpose trust, may be called star trust. If it is a single person trust, may be called a bear trust. So these are the types of trust, but basically there are two types. So I've just narrated these advantages of trust for various purposes, which I think we'll skip because I've already explained to you. Already explained trust will for estate planning, how it differs from the will. And then this is the types of trust. Now, basically two types, right? Implied and express. Implied trust is, creation of the law. Like when I say that I'm selling this property to you, provided you make me the payment within 60 days, and if you don't make payment within 60 days, the property reverts to me. It's called a constructive trust. So this is implied trust. This is express trust. Express trust is where the creator has created the arrangement. And then there is a executed versus executory, revocable, irrevocable, discretionary, non-discretionary. We're all well informed about these categories. Then within the discretionary and non-discretionary, there could be a life interest trust, where life interest are akin to Section 60 of the Income Tax Act, where we are only transferring income without transferring the asset. And once the life of the beneficiary is ending, then that trust is terminated. So these are the peculiar types of the trust based on the purposes of the trust. And this is a typical structure. That is a settler, there's a trust assets, beneficiaries, trustees, and protector. A protector is nothing but a guide to the trustees, who is normally appointed by the settler to look after and to check and balance the powers of the trustees. It could also be pronounced as, or it could be considered as an advisor to the trustees also. So these are the typical structure. Worldwide, same structure is followed. Maybe the financial sector uses the trustee as a separate company called management company, and a fund as a trust, which is a trust structure. And then they also have advisors in the form of investment advisor in different jurisdictions. Wherever they are operating actively, the advisor will sit in the active jurisdiction, whereas the trust and the management company will sit in a suitable, favorable jurisdiction for managing the funds of the others. Could be a private equity, could be a FVCI, or could be a mutual fund, or could be a captive trust for insurance companies and etc. So this is a typical structure with a dual ownership. Legal ownership lies with the trustees, and the ostensibly it is held for the beneficiaries, and therefore beneficial ownership lies with the beneficiaries. And normal documentation which are created for the purpose of formation of a trust is a trust deed, the letter of wishes, appointment of protector, or the advisors to the trustee, if any. And then there are, during the lifetime, a number of documents may be required. Resolution for appointment of the asset. So new asset is added. New asset is added to the trust. Then you require a resolution to appoint the assets or annex the asset to the trust. Then the beneficiaries may be added or deducted. Particularly when the contributory trusts are created in India for AIF, vehicle, and etc. Then investor comes and goes, and therefore there could be an appointment of beneficiaries and the removal of the beneficiaries in time to come. Then you have a resolution for distribution, and then you may have a resolution for termination of the trust. So this is the normal formation documents and the formation understanding for the purpose of a day-to-day practice in the office. So how the taxation of trust may be decided? You may have various types of trust, but for the purpose of understanding the taxation, we may divide into two different types called onshore trust and the offshore trust. Why onshore and offshore? Because not only your practice area will encounter the only Indian trust, because you are finally dealing with the settler, trustees, and the beneficiaries. Any three of them could be resident or a non-resident, or a mixture of resident and non-resident. So therefore, it is not, therefore, limit your understanding cannot be limited to the understanding which deals with the Indian trust with the resident and beneficiaries, resident trustee, and resident settler. That will be very, very limited scope to consider for the purpose of understanding the taxation of the trust. Then once you understand the onshore trust, offshore trust, and its tax systems, then the question comes up in the day-to-day practice as to which jurisdiction you must select. And in selecting those jurisdiction, normally one will have to understand the domestic tax law of that jurisdiction and what are the issues which you will encounter if the beneficiaries are of different countries and the settlers are from different countries and trustees could be in different territories. So the given a fact that the trustees are from this country, beneficiaries are from this country, and the settler is a particular person of a particular jurisdiction, then one can consider which particular jurisdiction you may want to select. And the number of factors which one has to consider is what we are going to see here. So, onshore trust, normally it is a tax neutral jurisdiction formed entity trust structure, maybe in a high tax jurisdiction. Generally, settler will be non-resident and beneficiaries also would be non-resident, but it could be resident also. Wherever the jurisdiction is a high tax jurisdiction or a neutral jurisdiction for the tax purposes, we have found that if beneficiaries of the trust are non-resident and settler is non-resident, generally they do not want to tax the trust structure. And in the offshore trust structure, it will always be the category of the settler and the beneficiary will be non-resident. But generally, it will offer no tax or a very low tax in the jurisdiction on the income of the trust. So therefore, if it is a high tax jurisdiction, if your income from that particular jurisdiction is very limited, you don't mind, setting up the trust in that jurisdiction because that jurisdiction will tax you only on the income which is sourced or arising out of that jurisdiction because all the beneficiaries are being non-resident or settler is also a non-resident. This system, along with the other benefits are whether it is good jurisdiction for the purpose of administration, ease of administration, for the purpose of attack by any creditors on the trust. There are a number of jurisdictions where if you form a trust today, then from that day, no one can attack that trust, either creditors or any revenue authorities of any other jurisdictions. Then there are trust jurisdiction where they say after formation of the trust, 2 years are allowed to be passed. Within 2 years, if there is a claim, they will entertain. Otherwise, they will not entertain. There are jurisdictions which offer 6 years, and there are jurisdictions which offers no protection from the creditors. Like English jurisdiction, particularly the 3 Isle of Man, Jersey, and Guernsey, English Crown Colony Island, do not offer you any protection from the creditors for the lifetime because they follow English law. They say that creditors can attack any point of time because your motive was to form trust at any point of time was to avoid the attack by the creditors. So therefore, there are a number of other uses to which it put depending on the jurisdiction because India has a less attack from the families as compared to the Western world. Western world, the immediate apprehension is the claim by the families, disputes, and etc. And immediate family, and therefore you can see there are a number of divorces which take place in the Western world, and for protecting the assets, these trusts are created. And I found trusts are being created for dogs and cats in the number of prominent and popular jurisdictions. So this is the use, and then the taxation. As I told you, we need to look at both the tax systems, domestic as well as the international factors, and then consider how to select the jurisdictions. So there could be a trust which itself be taxed in a particular jurisdiction. There could be a taxation of beneficiaries and trust is not taxed. Then there could be a payment by trust and the balance payment is made by the beneficiaries at the time of distribution and credit is given by the trust to the beneficiaries. See, this is a system in UK where they are given fixed credit on the income. So they collect the credit pool at trust level. And only when distribution is taking place, such a tax credit is distributed to the beneficiaries. And if the beneficiaries is supposed to pay tax at a higher level than the credit that is transferred or passed on by the trust, then in that case, beneficiary would pay the balance tax. That is the UK system. And then there are certain jurisdictions where trustees are responsible for making payment of taxes. And there are jurisdictions like India where beneficiaries are only taxed on the income earned by the trust. And they are taxed, the trust is taxed as if the income is received by the beneficiaries. And that is how India looks at it. India do not look at all what is the residential status of a trust or what is the residential status of a settler. They only look at what is the residential status of beneficiaries. If they are resident beneficiaries, we would like to tax them. That is the Indian concept. So again, if you make a survey, then you will find whether any jurisdiction is treating trust as resident on the basis of control and management, on the basis of where the settler is resident, or on the basis of where the beneficiaries are resident and where the probably assets are located. But India, as I told you, connects the tax liability on the basis of the residence of the beneficiaries. It's a resident beneficiaries driven. It is not a settler driven, or it is not a trustee driven, or it is not the location of the assets driven. So this is the, in nutshell, whether the trust itself is a taxable unit or not is to understand. We need to understand what is the function of each party and how could you trust, how can you tax the trust, because it is not that easy to tax this arrangement unless you treat that as an entity. If you treat this as an entity, the problem arises of where to tax and whom to allocate the income. Where to tax means whether a trust is a resident. When trustees are located at different places, you can't use trustees mechanism or trustees location as the basis for the residential status of the trust. When beneficiaries are located in multiple locations, how do you determine the residential status? So it is very difficult to decide the management and administration place or the place of beneficiaries or the place where the settler is resident. Settler, when settle the trust, irrevocable trust, he has no more interest in the trust. He doesn't come in the management and administration. He's not even beneficiaries. So therefore, settler is the least concerned item or a person who could be regarded as having a connecting factor with the tax liability unless it is a revocable trust where settler has a power to revoke the trust. In those cases only settler is important, otherwise settler is not important. Now coming to the Indian tax provisions for the trust, whether trust is a person. As you see the definition, the assets are transferred under the arrangement. Asset is not transferred to the trustee. It is for some particular arrangement, the assets are transferred to the trustees, and it is not transferred to the beneficiaries immediately. It is transferred to the beneficiaries subject to the conditions of the trust deed or of the letter of wishes. And therefore, I would like to think that trust is an arrangement or a contract, but not a person. Under the understanding the various ingredients of the trust structure vis-a-vis the trust law. Now, the tax law may impute whatever it may want to impute by treating trust as a person or otherwise. So, and that we have seen that trust could be taxed on the basis of settler or on the basis of beneficiaries or on the basis of the trustees or the location of the assets. These are the salient provisions of the Indian Income Tax Act, which are having some connection with the trust. Of course, 212(15) and 1023 C is for the non-profit making institutes. So, and 1113 is also for the trust, charitable and religious. Therefore, we will not touch upon them. Our important is sections are 60, 63, and then these are the relevant provisions of the Act. 139(1), etc., is for filing tax returns, and then self-assessment tax and the assessment liability to taxation. The charging provisions are covered under 160 to 167, read with section 5(1) and 5(2). Then I have simply covered 167B, which is taxation of AOP. There is some misunderstanding as to the taxation of AOP versus taxation of trust, and therefore I thought let me put this in the chart, that what is AOP and how AOP is taxed. Any question, Bharat or Sandeep, you want to ask at this level?
Quite a few questions on the chat box. Can you just have a look and or maybe you'll be taking it up later, I'm supposing.
Yeah, press slideshow button. Okay. Then whether the PPT recording will be made available to participants? Yes.
Yes, that we'll be sharing it on the CTC website.
I think there are no other questions.
Sir, on the Q&A box.
Q&A, okay.
Yes, sir, Q&A. There's 5 questions.
Yes, let me. I am not able to open it.
So you can just click on it. You just click on it, it pops up.
No, I'm not able to open this.
All right.
Just see in the security. You're able to allow
you will be able to access. As a co-host, you can access.
Am I doing something else?
No, sir, come out of the screen share, sir. The slide share. Yeah. So now, if you see the bottom of the page, you have the access controls.
Yeah, it is there.
Zoom access. So you have to come to Zoom.
Oh, Zoom.
Yeah, you have to come to Zoom.
Okay. Zoom control, I'm not able to see because of the occupation. Okay. What is the use of exception given by section 164? If ultimate income will be taxed at MMR only, tax should be at slab rate, but as per which provision? How would you interpret this scenario? I think we are covering this question later. So I would like to skip it at this junction. Life interest trusts are treated as a revocable trust for income tax. Life interest trust, yes, it is considered as revocable under section 60. The life interest trust are treated as revocable trust for income tax. Yes, answer is yes, because income is transferred without the transfer of asset, and therefore they are considered as revocable trust. All right, I think this one, there are some more questions. Can the term of the trust be extended or reduced by the trustee with consent of beneficiary only by the civil court? What is the procedure in this? Is there any implication of it in taxation? Yeah, before the period of trust, if it is to be terminated, then it is by civil court only. There is no there are certain powers of the beneficiary under the Indian trust law, but for the termination of the trust, the powers are only with the court. That's the answer. What is the procedure? Is there any implication of it in taxation? No, there is no implication. Since discretionary irrevocable trust is taxed at maximum marginal rate, how MMR will be calculated? MMR will be calculated without giving any threshold deduction at the rate provided in the Finance Act as the maximum rate for the individuals, which is defined under section 2(29)(c) of the Income Tax Act. That's the answer. Then there is a question from Usha, where there is only one beneficiary and income is added in the beneficiary return, whether return of trust is also required to be filed. If yes, then how to disclose income in the trust return? Where there is only one beneficiary and income is added in the beneficiary return, no, that is not permitted, because the tax liability is payable by the trustee, and trustee is supposed to segregate his income from the trustee's trust income, and he has to file a separate return for the trust under the representative capacity. So his income of a trustee under the representative capacity will be separately filed from his capacity, but beneficiary is not allowed to add his income to his return. That's the answer for Usha. What is the status of the trust where beneficiaries are resident as well as non-resident? That, as I told you earlier, under the Indian income tax law, there is nothing like trust is resident or a non-resident. They want to tax the resident as beneficiaries. Whether they are beneficiaries in the Indian trust or the offshore trust, both they want to tax under the Indian income tax law. Then the question from Floyd, in case of MMR, will the surcharge depend on the income of the trust, or will the 37 surcharge apply irrespective of the level of income of the trust? No, yes, surcharge will apply based on the level of the income of the trust. It doesn't stop at 37%. I think it stops at 43%. Can you throw light on possibility of perpetuity or the duration of the trust? Normally, perpetuity is 99 years. And therefore, trust will be valid for 99 years. And possibility of perpetuity is possible up to the settler who can devise a trust for the child as well as for the potential child, and not thereafter. Can beneficiary and settler be the same person? Is there any legal litigation involved? Can beneficiary? Yes, beneficiary and settler be the same person is possible. Is there a legal litigation involved? There is no legal litigation involved. Only thing is, when beneficiary, settler and trustee, all three are same, it may be treated as a sham trust. Can a non-resident be a settler? What is the view of the registration authorities? Yes, non-resident can be a settler. I think will benefit of section 112 and 112A be available to the trust taxable at MMR? Yes, the special rate benefit is available if you can identify that this is your capital gains income, and you will be allowed this special rate. There are court decisions in favor of this special rate being available to you. Then Ms. Rutuja Soni, is it only the settler who can settle or contribute assets funds in the trust, or even the beneficiary can contribute towards the trust? No, it is reverse. A settler, after settling the trust asset, can be a beneficiary. So that is the question. That is the right way of thinking this particular structure which you are referring, Rutuja. Under FEMA, if trust is considered as non-resident, whether gift to trust will be considered as utilization of RRS limit. This answer we will take it a little later when we get into FEMA. Yeah, I think these are all questions which are currently on Q&A, and I think I've answered all of them.
Yes, sir. I think you can proceed, sir. So you need to share your screen. Share your screen and then full screen thereafter. Yeah, full screen.
All right.
Yeah. So to the subsequent slides.
Yeah, I'm taking that.
Yeah. Yeah. Right.
Yes. So therefore, a lot of questions have come up, which appears to me that all of you know the law very well. So my task is a little easier, I believe. Okay. So residential status definition is here 6264, whether trust could be regarded as resident or is there a person. We were supposed to answer that question first in order to take the discussion further. See, there are number of decision. I think one slide is missing. Okay. There are a number of decisions where it has been held that trust is neither an AOP or BOI and nor it is a juridical person. As I explained to you, trust is not an entity, it is a contract, it is an arrangement. So how can you decide the residential status of a trust when it is a contract and it is not a person? So in fact, if you see definition of trust as a person into 2 into bracket 31 talks about AOP, BOI, and artificial juridical person. None of them three is includes the trust, and therefore, our definition of person does not include trust. If that does not include trust, there cannot be any residential status of a trust. And understanding the entire scheme of the law, and that is the reason why a vicarious liability has been imposed on the trustees as a representative assessee. And if you also see the scheme of the law 139(1), TDS provisions, etc., that the importance of representative assessee has been found everywhere. That you are assessed as for your income or for the income of other person, then also you have to file the tax returns. And then the similar is the situation you find in section 160 to 64, where a representative assessee has been defined and the tax liability of the representative assessee is also defined. For the simple reason that the law does not envisage the trust as an entity or a person, and the importance of residential status, or irrespective whether it is a resident or a non-resident, it will not be taxed in accordance with that particular principle, but it will be taxed in the hands of the representative assessee and in the like manner as if the beneficiaries were taxed. So that is the law as per the provisions of the Income Tax Act, which are found in section 162, 166A. Now let us look at the couple of judgments, that how do you consider the taxation of the income when beneficiaries are resident but their income is not determined, or where their income is fixed or determinable. It poses a lot of questions. So let us go to the taxability of the private trust. If you see, when the shares are determinate as provided under 161, and when the shares are not determinate, the liability is provided under 164(1). And 160 talks about the representative assessee, who can be regarded as a representative assessee. Now, if you see, if the income does not include business profits, then trustee is assessable at the rates applicable to each beneficiary, and threshold is available to each beneficiary. Now, if all the beneficiaries are individuals, then threshold is available to them of whatever the income, the minimum income, which is not liable to taxation under the Income Tax Act as per the Finance Act. When it says where income includes business profits and beneficiaries are determinate, the whole of the income of the trust is taxable at maximum marginal rate. And in case where it is indeterminate, the income is taxable again at maximum marginal rate. And when it is a normal provisions of the act, like what we have, the individual tax rate will apply and threshold will apply. Here it says the income of the trust is taxable in the hands of trustees at the rates applicable to an AOP. Not that it will be taxed as an AOP. It will be taxed at the rates applicable to an AOP. Therefore, threshold will be impacted. There are three beneficiaries. And if your shares are indeterminate and you are supposed to make a payment of taxes at the AOP rate, then your threshold is impacted. And also, if any of the beneficiaries are income larger than the maximum amount of the threshold, then also tax will be at a higher rate. And in case where it includes business profit, then MMR. So there will be some concession in the AOP tax rate as compared to the MMR, basically. So that's what it says. If it does not have a book business profits, then you can see three slabs, basically. The slab one is threshold available to each beneficiary. That's a lower level of taxation. The second lowest is the AOP tax rate. And the third, which is highest, is the maximum marginal rate, which are both are covered here. Here it is AOP and MMR. Here it is individual and MMR. Therefore, there is a benefit when the shares are determinate. But there is absolute maximum tax payable when you have indeterminate share. And particularly when you have business income, then you pay the highest tax in the private trust. I think this is the basis of the tax liability. And then the number of question arises, Yes. We may go into little discussion about the distinction between the AOP and the trust. What the law says, the jurisprudence basically on the subject, and particularly right from 1960, the Supreme Court held that trust is not an AOP. Why? Because the ingredients of AOP are that the various persons joining for any peculiar or a particular purpose, or if they are joining for any action for some common benefits, then in that case, that is treated as the AOP. But here, in the case of trust, the beneficiaries or the beneficiaries and the trustees are joined together not for their own voluntary act. They're joined together for the act of a settler, whereby they are either obligated as a trustee, or they are to get some benefits either today or tomorrow. So therefore, there is no voluntary joining together. It's called joining together means voluntarily coming together. Whereas if you are not coming together voluntarily, that cannot be an AOP. You are forcefully, or if you are under the compulsion for benefits, you have come together and there is no common purpose of action or joining for some other purposes. So then therefore, in this case called Indira Balkishan's case, reported at 39 ITR 546, the AOP has been distinguished from the trust. I think the other assessee or other person like individuals, juridical person can easily be distinguished from the structure of the trust, whereas AOP was slightly very close to the consideration that probably settler or the trustees and the beneficiaries together constitute AOP, and therefore the income should be treated as the income of the AOP. But after that decision, number of decisions have followed these decisions, and it was never treated as the AOP. Now, the other issues which are relevant is, if the trust is not an AOP, if a trustee is required to be taxed in accordance with the provisions of 161 and 164, and as a representative SSE, what is the liability they say? The liability is very simple. What is I will just read out the act. Sorry. Liability of a representative SSE. Every representative SSE, as regard the income in respect of which he is a representative SSE, shall be subject to the same duties, responsibilities, and liability as if the income were income received by or accruing to or in favor of him beneficially, and shall be liable to assessment in his own name in respect of that income. But any such assessment shall be deemed to be made upon him in his representative capacity only, and the tax shall, subject to the other provisions contained in the chapter, be levied upon and recovered from him in like manner and to the same extent as it would be leviable upon and recoverable from the person represented by him. Therefore, trustees cannot be asked to pay the taxes which beneficiary would have otherwise paid. So if the beneficiary is individual, then the tax will be paid at the individual rate when the trust is a determinate trust. The question, therefore, is very simple. When the trust is determinate, there is no difficulty. But the beneficiaries are the combination of individuals and the other persons, there could be some difficulty. However, in case of a determinate trust, there cannot be any difficulty, because if, let us say, one beneficiary is individual and one beneficiary is a company, then you need to compute the company's income and the individual's income separately and add together the tax liability and pay. And that is the responsibility of the representative assessee to make the payment of taxes. Then the question arises, in the hands of beneficiaries, company is receiving the income as well as the individual is receiving the income, with the very clearly demarcated nature of the income, whether it is a income of interest, dividend, capital gains, etc., etc. So the question is whether the individual will get a subsequent deduction from this income because they have received the income from dividend, whether ATL will be available to them. So now not ATL, earlier it is from interest income. Dividend is separately taxed now. Earlier under 150 no, and now 150 has been removed, and therefore it is taxed in the hands of the shareholders. So therefore beneficiary will be taxed accordingly. However, interest income, bank interest, etc. are subject matter of deductions. So those deduction will also be available to those beneficiaries when the share of such distribution or such income from the trust is allocated to him, he is also entitled to such deduction. Even if the company, in case of company, if a company is receiving dividend from the trust, then they will be entitled to ATM deduction also. That is what the law is, because the trustee is not supposed to deviate from the computation of income of the beneficiaries. He is supposed to compute the income of the beneficiaries in the same manner in which beneficiary would have computed. And that is the law, and that law has been followed in number of subsequent decisions also. The question arises, in case of a indeterminate trust, how do you compute the income? You know that in the determinate trust, the identifiable beneficiaries were there. If they were different nature of the persons, like individuals and companies, you could combine the aggregate tax liability and pay it. But in case of an indeterminate trust, the courts have held that the trustees together will be treated as a taxable unit and will be treated as an individual. Like CIT versus Deepak Family Trust, Gujarat High Court, and CIT versus Sri Krishna Bandar Trust, 1992, Calcutta High Court have held that where all the beneficiaries, the individual status of the trust would be that of the individuals. And in case there is a combination and specific trust, there is no problem. But if an indeterminate trust, the unit of the trustees will be treated as individuals and will be taxed accordingly. So this is about 161 to 164, mainly 161 and 164. The three variations: normal income of the trust where beneficiaries are known, simple, aggregate the tax liability, no issues. If the trust has a business income, then MMR applies, and special rates are also available to such trust. And the shares are indeterminate, AOP rate if there's no business income, and MMR if there's a business income. And in these cases, how do you compute the income of the individuals and the other SSCs, whether these deductions which are available in the specific trust would be available to them? Not probably initially when tax is paid at a MMR or AOP rate. However, when a distribution takes place, it's the same income which is distributed to them. And therefore, at that point of time, there may be some scope to get those deductions which are otherwise available to the beneficiaries of the specific trust. So therefore, these are the various jurisprudence. As I mentioned earlier, all the benefits, deductions, or allowances which an individual beneficiary could have obtained are also available to the trustees assessed in representative capacity. For instance, benefit under Section 54 of the Act in Kama's case, ATM in case of companies. One of the contrary judgment also is found, which is in 327 ITR 490 Delhi High Court in Srimati Pushpawati's case, CIT, where it said that the trust would constitute an AOP. I think, with due respect, only AOP rates are to be considered and not the status of the trust could be AOP because of the various reasons which we have discussed so far. This is only the law basically which I have reported here. So no need to go into details. Then we also have the various types of trust regime, a separate regime from and distinct from a provision of Section 160 to 167, where the treatment at the entity level or a trust level, I would not say entity because trust is not an entity, and at the beneficiary level have been slightly modified than the provisions of section 161 and 164. And these are found in the mutual fund business, the investment trust, and the REIT. I mean, tempered, this particular provisions of the business trusts are tempered many times for one reason or another reason. And last, the tempered version was the law has to be changed in these cases also due to the changing the method of charging the dividends. You abolished 1150, and therefore a shareholder level dividend tax have arisen. And in case of mutual fund and other, they were supposed to pay additional tax if the distribution was made. And now, since shareholder are, or the mutual fund or the unit holders are themselves taxable, there was no reason to retain taxes at the trust level. So therefore, those regimes are a separate regime. We cannot go into the details of 115 UA, UA2, 115R, TA to TF, because it's a subject by itself. And these provisions are to be read along with the section 10, because the benefits are given to the beneficiaries in terms of exemption in section 1023 FAFB kind of the scheme. And therefore, this entire regime is a separate regime from the scheme of the 161 and 164. So it brings us to two important decisions. Very, very peculiar decisions. One is in case of Maharaja of Gondal, and another is Renu Tharani's case, which is ITAT decisions in Renu Tharani's case. In the Maharaja's case, it was the two trusts, one in US and one is UK. There was a long history of litigation in those cases. For a few years of establishment of the trust, the family paid the taxes in India, although those trusts were in UK and USA. And thereafter, they found opinion that it's a discretionary trust, and there is no hope for the beneficiaries to get the distribution from the foreign trust. So whether the Indian provisions of MMR, AOP, etc. will be applicable to such trust. So in the peculiar circumstances, if there is no information or there is no possibility of the computing the income under section 5.2 or under 161 and 164, because the trustees are not able to decide what could be the income or whether any income has accrued before the distribution, was a point before the court, of course, before the Supreme Court. So it is our normal understanding that even if it is a discretionary trust, there is no distribution, the tax will be leviable. However, in this case, Supreme Court held that if you read the scope of the income, section 5.2 for the resident, income accrues or arises or deemed to accrue or arise. Sorry, for resident, there is no deemed to accrue or arise outside India. There is deemed to accrue or arise in India only. So therefore, whether such income is said to be accrued in the hands of the resident, which was the grandson of Maharaja. And it was held that this is the income which is of a discretionary trust. It is with the trustees to decide when to distribute the income and to whom to distribute the income among the set of the beneficiaries. And under these circumstances, whether can it be said that section 5 is triggered, where there is no accrual of the income in the hands of the beneficiaries at all, whether discretionary or non-discretionary. If it is non-discretionary, one can say this income, although have not been distributed, but accrued to the beneficiaries. It is only a question of deferring the distribution. But in the case of a non-discretionary trust, the 5(1) does not give rise to any charge. 160 into bracket 1 says, if the representative capacity is in receipt of any income for the benefit of the beneficiaries, or can it be said a particular beneficiary has received the income when the trust is discretionary? The Supreme Court in that particular circumstances taken a stand that even trustee do not know what will be the income which will accrue to a beneficiaries under the discretionary trust structure. And therefore, in Maharaja Gondal's case, Supreme Court said in both this trust, income will not be liable to tax in the hand of trustees as a representative assessee for the income of the resident beneficiaries. It's a very important decision because the Renu Tharani's case is exactly in the different direction. Of course, it was a 147 and 148 scheme of reassessment. The question arose before the ITAT whether the assessment has been validly reopened. The answer is yes, because the department was in possession of the tangible and credible information about the existence of the SSC's account with HSBC Bank Geneva. In this peculiar case, although it was a discretionary trust, the only beneficiary was the appellant or assessee, Renu Tharani. And in those circumstances, the ITAT held that this income will be liable to tax in India in the representative capacity, and trustee is supposed to pay the taxes. If the trustee does not pay taxes, the taxes will be recovered from the beneficiary. That enabling provision is always there in the Indian Income Tax Act in form of section 166A. So therefore, in these particular circumstances, a foreign beneficiary, Indian beneficiary, resident beneficiary, was a beneficiary in the trust. There was an underlying company which has invested and has made the payment, and therefore it was considered as the income on a current basis, irrespective whether it was distributed or not. And that was treated as an income of the individual resident beneficiary, Renu Tharani. Then we come to anti-avoidance provision. We have already seen section 60 in the form of question from the participants. That all income arising to any person by virtue of a transfer, whether revocable or not, and are affected before or after the commencement of this act shall, where there is a no transfer of the asset from which the income arises, be chargeable to income tax at the income of the transferor and shall be included in his total income. So it is considered as a revocable transfer. Similarly, if property is transferred with the power to revoke, then it will be a revocable transfer and the income will be assessed in the hands of a transferor. And there is a definition of what is transfer and what is a reservation, etc. I think it's very plain and simple case. Only question which arises to me, one may have to look into the provisions of section 64 of clubbing. When the settler is husband and wife is a beneficiary, when settler is an individual and daughter-in-law and a minor child are beneficiary in the trust, and department try to club it because they will always say that it is the transfer directly or indirectly without any consideration, and therefore section 64 1 into bracket Roman 2 for spouse, bracket Roman 4 for spouse, then into bracket Roman 5 for daughter-in-law, into bracket 7 and 8 transferred to the individual in AOP for the first subsequent benefit of wife and daughter-in-law. There are interesting cases in the trust jurisprudence in this area also, that when a trust was created for a minor child by one Mr. M.R. Doshi, and the peculiar trust provision was that this minor child will be able to get the distribution from the trustees only when all the beneficiaries, along with the other children, attains the majority. So when they received the funds after the attainment of the majority, the Supreme Court in this case held, CIT versus M.R. Doshi, reported at 211 ITR 1, that such an income cannot be clubbed and has to be taxed in accordance with the normal provisions of the law. So this is about the minor trust. And there was one more case of the settled on potential son-in-law and daughter-in-law. And the marriage never took place for 20 years. And the trust assets reverted back to the settler. Again, Chennai High Court held in this case that for the 20 years, the trust was assessed as a income in the hands of a trustee as a separate taxable unit is perfectly fine. And when the assets reverted to settler, there cannot be any income arising from such reversion to the settler. That was the in background of the clubbing provisions of the Income Tax Act. That leads me to go to the life cycle of the trust and how.
Sorry. Would you want to take some questions now?
Yes, please. Yes, please.
Yeah.
I'll just try here. I can get into. Again, I'm not able to go from here.
That's okay. So if you can just disconnect screen share, I'll share the screen.
Okay, 1 second.
So after that, I'll do it.
Yeah, okay. Yeah.
So can you see the screen?
Yes.
Yeah.
Oh, something else has come.
No.
Screen has gone, I think. Can you just... Yes, it has come.
It's come?
No, really not.
No?
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 No.
Something
else is coming. See the... Yeah, Q&A is coming now. Hello?
Yes, sir.
I can see the Q&A.
Okay, done.
Yeah, but yes. But there's the same thing which are appearing earlier.
Yes, sir. So I think from Manish's question, I think you have...
Now there's one question, Abhi Desai. Correct?
1 minute.
Yes. Yeah, there is question now. Yes, I can see.
Yes,
in M.R. Doshi's case, when accumulated income is handed over to measure, what will be the tax treatment in his hands? Now see, this was a discretionary trust. It was accumulated. The trustees already paid the taxes actually. It was only from the perspective of the clubbing provisions, whether the clubbing was required during the intervening period. So that was held not to be considered. So that is answer to Manoj Gupta. Then we have Nimish Unatkat. In a discretionary trust, where wife and major son of the settler are beneficiaries, the trust distributes assets to the wife as beneficiary, whether clubbing provisions become applicable. Yeah, that is what we have discussed, 6414, where, but there's a lot of argument you can make to the clubbing provision, because can you say that you have transferred these assets only for the purpose of transferring the benefit to the wife, and then the purpose of settlement was as succession planning? In any case, she would have received the money after the lifetime of the husband. And if arguably a good case to fight, but invariably department will add this to the income of the husband who is a settler. Next question is again from Abhi Desai. Can a husband be a settler of the trust and nominate wife and minor daughter as beneficiary of the trust? Yes, no problem. And transfers the movable and immovable property into the trust? No problem. With the clubbing provision will apply. That is a problem. Next question is Rutuja Soni. See, again, sorry, I missed out one point in both these questions. You are not worried about 56(2), but you are worried about clubbing. That's what I wanted to say. Because they are specified relatives. Where settler and beneficiaries are the same person, in your experience, is there any tax exposure under section 56(2)? Rutuja, if settler himself is a beneficiary, then 56(2)(10) will never come into picture, because it cannot be said as a gift to the self, right? So that question will not arise. Any estate duty implication, etc. There is no estate duty we have in India currently. Therefore, there is no implication of estate duty in India. Next is from Ashwini. Also, how to apply for PAN of a private trust as AOP or trust. As I mentioned to you, that if all the beneficiaries are individual, it's a status of individual, we will apply for the PAN number. And based on this Chennai High Court judgment in 88 ITR, even if it's a discretionary trust and the combination of the beneficiaries, we can still consider the unit of trustee as the individuals and get the PAN and follow the return accordingly. Under section 164(1), when beneficiary are indeterminate and the income does not include business profits, how is the trust income tax in the hands of trustees? When beneficiaries are indeterminate, the trust will pay taxes. Beneficiaries are indeterminate. There are two tax rates. AOP rate, basically, they'll pay tax rate at the AOP rate. That's the answer, John. Morally, if trustee is liable to tax as a representative SSC, then how can the trustee apply for PAN in his individual capacity? Yes, not in an individual capacity. He himself will apply in a representative capacity for that so-and-so trust. Nimish, a person has sold immovable property. A new property is acquired in the name of trust. Whether the said person is sole trust, where a new property is acquired in the name of a trust, where the said person is sole beneficiary, can exemption of section 54 be claimed for that? Yes. A person is sold immovable property, a new property is acquired in the name of trust. Okay. Where the said person is sole beneficiary, can exemption under section 54 be claimed for that? See, a new property is acquired in the name of trust. You not mention about it's a specific trust or a indeterminate trust, because when you get the share of income from the trust and you apply you get the nature of income from the trust. That is correct. But here, you are selling the property and settling into a trust, you are trying to take benefit, probably will be difficult proposition. Istiak, under FEMA, if trust is considered as non-resident, whether gift to trust will be considered as, we have covered this question already.
We've done the rest of the questions, we've done it.
Yeah, Nimish says it is a specific trust. I think it will be a difficult proposition then also. Yeah, okay. This we have completed. Now I go to share.
Yes, sir.
Yes. Tax returns.
Sir, if you can full screen it, sir.
Yeah, I'm doing that, yes.
Play from current slide, you can just.
Yeah. Oh, play from current slide I was supposed to do. Yeah.
Yes, sir. Yeah.
Webinar, I have to have my tea and you have to have your tea.
Yes, sir.
See, section 139, 1B, there are two subsection A and B. A is for company and firms, and B is for individuals and the income of other persons held by individuals. So they say that, yes, you are required to file the tax returns if income is above the threshold limit in case of individuals, right? Now, a very interesting proposition that if there are specific trust and the non-specific, or a determinate and indeterminate trust, right? So with a determinate trust, if all the beneficiaries' income is below taxable, not supposed to pay any income tax, the representative assessee will not be liable to file any tax return. But if there is no income, but if one of the beneficiaries is a company in a specific trust, a representative assessee will be liable to file tax returns because it will not fall in 131 1B, but it will fall in 139 1A. So that is the interesting features of this tax filing. And then in case of a indeterminate, if there is a tax liability, because there will be tax liability in the case of indeterminate, because either the EOP rate will apply, AOP tax rate will apply, or the maximum marginal rate will apply. So therefore, in those cases, again under 139 1B, income of other persons being taxable, return will be required to be filed. And if in cases where all company are the beneficiaries, then irrespective whether there is a tax liability or not, if there is a loss also, return will be required to be filed. So that's about 139 1B and 1A, and the representative assesses liability in a like manner, in the like manner and the like way, this will be required to be filed. Then question arises about the Indian resident who are beneficiary or the beneficial owner in the overseas trust. Both this term beneficial owner has been defined in explanation 4 to the section 139.1, and beneficiary is defined to the at explanation 5 to the 139.1. In these cases, they say return is required to be filed if you are covered by this clause, irrespective whether there is a taxable income or not in case of individuals. Now say beneficial owner is defined as the one who has contributed to the assets of the foreign trust directly or indirectly, then he is a beneficial owner, irrespective whether he is a beneficiary in the trust or not. And then the beneficiary, it says, if he is in the enjoyment of any benefit of the foreign trust, then he is a beneficiary when he has not directly or indirectly transferred any consideration to the foreign trust. So, therefore, there are views and the alternative views. The beneficial owner is a settler, therefore, I don't see there is any choice for him not to disclose that he has settled the trust abroad, although he is not the beneficiary. That is possible. And the second case, the person has not contributed anything, but somebody has named his beneficiary. He may know or he may not know. The one view is, conservative view is, if you know that you are named as a beneficiary in the discretionary trust, you may include it in your tax returns. But strictly speaking, if you see the meaning of the beneficiaries, explanation 5 to 139.1, then it says, if you have enjoyed any benefit during the previous year, then only you are required to file tax return with this disclosure. And therefore, probably in case of explanation 5, you may avoid filing the tax return if otherwise the income is not liable to taxation. Now we come to the cross-border international tax issues. Now, what is a cross-border tax issues? Two things. If we say, without creating much complications, that the Indian resident is a beneficiary, is in a foreign trust, and a non-resident is beneficiary in the Indian trust. This is the simplest form of cross-border trust, basically. So what question arises, basically, as you know, if you're a beneficiary in the foreign trust, and if the foreign trust is taxed differently than what Indian, then as compared to the Indian income tax law, taxes the beneficiaries. The number of issues which arises in terms of the nomenclature and allocating the tax liabilities to such trust, that tax liability be allocated to whom and how to take the benefit of the tax treaties. And also, this law of the foreign jurisdiction depends on whether they follow the system of civil law or a common law in that jurisdiction. I hope all of us know what is common law and the civil law. Just one line I will say. Civil law follows the strict interpretation of the literal interpretation of the law, whereas common law operates where the equity is also interfered within the literal meaning of the law. I think that is enough to understand that the interference of equity in the literal interpretation of the law is the common law jurisdiction, and the civil law jurisdiction where equity do not interfere at all. If you see civil law countries like most of the European countries except UK, of course UK is not a European country, you will find a civil law, whereas the UK follows the common law system. And we also follow, to an extent, a common law system. So if you say the pass-through approach, then again, if it is a pass-through approach, then more or less the beneficiaries will be taxed. However, most of the tax system do not have the approach which is a pass-through approach. As we've seen, it could be settler-driven. You will find in New Zealand it is a settler-driven. Wherever settler moves, tax liability moves. They completely treat the trust as a anti-avoidance tool. Therefore, they don't want to leave settler. Whereas India want to take care of beneficiaries only. They don't want to go behind settler or the trustees. Trustees only if beneficiaries don't pay taxes. Okay, if you all know the tax treaties, if a resident beneficiary, Indian resident is a beneficiary in a foreign trust, a number of issue arises in the source country and us also, that how this articles will be applied, whether you will be treated as person or not, whether who will be treated as whether the taxpayer is considered as beneficiaries, is a taxpayer or not, whether for the purpose of Article 10, 11, 12, and 23, who will be treated as a resident of a contracting state, whether the beneficiary will be treated as a resident of a contracting state or a trustee or the settler or where the assets are located. So these are the issues in relation to the trust structure settled in a source state. And therefore, this, and also when there are capital gains, then who will be treated as an alienator? Whether the beneficiary will be treated as an alienator or a trustee will be treated as an alienator. So these issues are now attempted to be resolved by the BAP Section Plan 2, which is replicated in Article 3 of the MLI to resolve this issue. But to my mind, issue will still be unresolved. And also, there is an important literature in terms of partnership report of 2009, OECD partnership report of 2009, how to treat such transparent entities in light of the complexities which has involved to apply the double tax avoidance agreement. India has reserved a status quo position and do not want to do anything. And most of the countries have amended their local laws in line with the OECD guidance in uniformity, so that the other partner to the treaty is able to give tax credit efficiently. Like this is the typical cross-border taxation of situation where trustees are located at T1 to T2 and T3 places. Beneficiaries are located at B1, B2, and B3 places. And the assets are located in 3 jurisdictions. Then in this situation, how do you resolve the issues which are concerning the deployment of the tax treaties? Person to whom income is attributed, trustees or beneficiaries or settler. So as I mentioned to you, special rules in the DTA to incorporate conflict of attribution, but to whom the income will be attributed. The partnership report of 2009 and new article 1.2, 1 into bracket 2 into the OECD Model Tax Convention is introduced and replicated as Article 3.1 of the MLI to remove the hybrid mismatch. India has maintained the status quo in the matter. Now this is the case study or cross-border trust. And then after this case study, we go to the FEMA aspect. The case study is like this. This is the trust. A Mauritius discretionary trust set up under the law of Mauritius for the beneficiaries in UK, USA, and India. One of the beneficiaries in India, and it is an indeterminate or called a discretionary trust. And settler is not a resident of any of these 3 countries where the beneficiary is located. Is a non-resident of India, UK, and USA. And Mauritius Discretionary Trust has formed a global company and invested in investment assets 1, assets 2, and assets 3. And realizing the income from this particular investment, which is a non-business income of a discretionary trust. There are interest, dividend, and royalties, and etc. is the income. Then you are required, this group, allied group, is required to consider whether the income of this Mauritian trust will be ever taxable in India if any of this situation when trustees are resident of UK, USA, or India. The first question is whether the income of Mauritian discretionary trust will be taxed in India if trustees are from UK or from USA or from India itself. That is the question number 1. Question number 2 is whether the income of Indian resident will be taxable and how it will be taxable. That is question number 2. And question number 3 is when an Indian resident is a trustee, whether the income of the beneficiaries of which are located in UK and USA will be taxable in India or not. They are the very simple situation I have covered in this particular case study. And if in case tax is payable in India by Indian resident, whether there is any possibility of a tax credit. That's the last question on the subject. If you see, you always read this section, but I'm just reading it again. All income from whatever source is derived, which is received or is deemed to be received in India in such year by or on behalf of such person. So by or on behalf of such person. So it includes the receipt by a trustee on behalf of such person. So Indian resident is received or is deemed to be received in India. It is not received in India. Then accrual arises or deemed to accrue arise to him in India. So this accrual arises not in India, outside India. Deemed to accrue arise also not in India, outside India. Accrual arise to him outside India during such year. So C is relevant. Whether the income accrues or arises to Indian resident beneficiaries of a discretionary trust when trustee do not know to whom what distribution may be made in future. It is only beneficiary only lives in hope that at some point of time the distribution may take place and he may get some distribution. So whether in such a case, whether Indian resident beneficiary is liable to taxation or not is a question in the light of section 5. And 5.2 is for non-resident, which is for US and the UK person. Is received or is deemed to be received in India in such year by or on behalf of such person. Whether in any circumstances, these UK and US resident will be receiving any income in India by a Mauritian trustee or a UK trustee or a US trustee or an Indian trustee. So Indian trustee is also not receiving anything in India. Then accrues or arises or is deemed to accrue or arise to him in India during such year. So for non-resident, nothing accrues in India any of these years, right? So therefore, there is no question of keeping any liability of a non-resident in India, which is the income arising in the Mauritian trust to the credit of the non-resident beneficiaries. Only question arises, therefore, the taxation of the Indian beneficiary in the different circumstances. Now, reading at 161.4, in respect of income which a trustee appointed under a trust declared by a duly executed instrument in writing, whether testamentary or otherwise, receives or is entitled to receive on behalf or for the benefit of any person, such trustee or trustees. Whether he receives on behalf of any beneficiaries, does he know that he has received on behalf of a beneficiary in India? Receives or is entitled to receive on behalf or for the benefit of any person. Then such trustees or trustees are liable to, as a representative, assess and make the payment of taxes as per 161.1. Every representative assessee as regards the income in respect of which is representative assessee, subject to the same duties as that of a resident or a non-resident. So therefore, this liability will be decided in accordance with the 5.1 in case of resident and 5.2 in case of a non-resident. If it is not, then it is said, subject to the provision of 2 and 3, where any income in respect of which a person mentioned in clause 3, 4, and are not liable, are liable as a representative or any part thereof, is not specifically receivable on behalf or for the benefit of any one person, or where the individual share of the person on whose behalf or for whose benefit such income, such part thereof is receivable, are indeterminate or unknown. then such income, such part of the income and such persons being hereafter in this section referred to as relevant income, part of the relevant income and beneficiaries respectively, tax shall be charged on the relevant income, or part of relevant income at the maximum marginal rate. So do you know the quantum of the relevant income when the trust is indeterminate? The answer is no. No distribution is made to any of the beneficiaries either in UK or USA or India. What is liability for trustee as represented USCC? The test to be applied does not cover the income of the beneficiary who are non-resident or resident, whether income can still be chargeable to tax in hands of the resident or non-resident trustee under section 164(1). How to compute when part of the beneficiary are resident and part of the non-resident? Is it possible to compute? Is it possible to say that whole income is liable to tax in the hands of the Indian resident beneficiaries? Well, it's not possible to quantify. But if you are not able to quantify whether the charge fails, because charge is very clear. If it is indeterminate, then such income, relevant income, but here relevant income cannot be quantified even. Can it still be taxable in India? Again, we have a tool called protective assessment and its nature. Probably assessing officer may apply in case there is a tangible information that there is a creation of trust for an avoidance of the taxes in India. So when trustee is resident in Mauritius, answer is no. When trustee is resident in UK, answer is no. When trustee is resident in India, answer is no and yes both. Yes, because he is a resident trustee, he is aware that one of the beneficiary is an Indian resident, the liability triggers, but quantification fails, but protective assessment can be made. So this is the scenario in which you are posed in this particular situation. There is no clear-cut answer, but you may look into the trust deed, letter of wishes very, very carefully, whether you get some chance to say that income has never accrued to the resident beneficiaries at all. So this is about the taxation of trust in India and beneficiaries in India. In case of a distribution, Indian beneficiary is liable to taxation in all three cases. When there is no distribution, UK resident beneficiary, US resident beneficiary not liable to tax unless it is received in India. Very clear. Section 5, into bracket 2 scope, deemed to received or deemed to have been received in India. In case of distribution, again not liable to tax India because they are non-resident and income is accrued outside India. In India, UK DTA, India, US tax treaty, not liable to taxation unless assets are located in India. Because if there are immovable properties in India and these immovable properties are held by trust in Mauritius, and if the beneficiaries are US beneficiaries and income is arising from the Indian immovable properties, then only there could be some tax liability in case of the US and the UK beneficiaries. So therefore, we come to the last question, whether tax credit issues. If the tax is paid by the trust outside India trustees, whether the credit in the hands of the beneficiary is available. If there is a treaty. And if there is a treaty, can you get the unilateral tax treaty benefit? The second question can be answered in negative, because if there is a treaty, then the benefit of tax credit has to be taken in accordance with the tax treaty. However, the domestic tax system in India may be able to give you a tax credit because the India taxes the income of the beneficiaries. And if in case of an indeterminate trust, if the taxes are paid by the trust, on distribution, there are no payment of taxes. And therefore, to that extent, a foreign tax credit will be available. And to the extent tax is not paid, you may be able to have You may be able to pay balance taxes in India. Then there is a provision of Section 93 of the ITX, just a side attraction, that if a non-resident forms a trust and then he becomes resident in India, then what happens to the Section 93 provisions? Then, it says that if a trust is created by a settler, and if a resident beneficiary enjoys the benefit of such a trust, then the beneficiary is liable to taxation of the income of such a trust or such an asset arising from the settlement. So, but under the bona fide cases, this provision of Section 93 will not be applied. But it's a very deadly section. You must read. It says, wherever there is a transfer of assets, whoever transfer is not concerned. In a case wherever there is a transfer of asset leading to the payment of income to the non-resident, leading to acquisition of rights by the SSE, which enables him to enjoy the income of the non-resident. That means when you are non-resident, you settle the trust. Now you become resident. You are now again enjoying the assets of that trust, or some benefits you are deriving from trust, a credit card benefit, or if the immoral property is owned by the trust, you are enjoying the staying facility in that trust, etc. Such income would have been chargeable to tax had it been the income of the SSE. Then income shall be deemed to be that of the SSE, subject to the exemption for bona fide transaction to the satisfaction of the assessing officer. Very deadly section. We want to be very careful in devising such trust. So this is about what we have discussed so far. Now we go to the FEMA aspects of the trust. We straight away go to the slide number 78. 63 to 64 is general explanation of FEMA aspects of trust. That what is the nature of this transaction, whether it is a capital account transaction or a current account transaction, whether trust is treated a person or not. Same analysis what we were doing for the tax purposes. Again, FEMA also does not define trust. Same issue. Discretionary. The example. I'll take two examples. Non-resident settler and non-resident beneficiaries. Similarly, non-resident settler, resident beneficiaries, and trustees are non-resident, specific trust. So these are the example of the typical situation in which we can come up with the trust structure. But going to the crux of the life cycle, I think we have forgot to consider life cycle in the tax provision. Yes, when we settle the trust, Section 47(3) says assets transferred to the revocable trust will not be a transfer, right? And also when we distribute to the beneficiaries, if the income is already assessed to tax in the hands of the trust, the distribution will not be attracting any taxes. That's a life cycle. There is settlement, the income earning apparatus of the trust, and the distribution. Similarly, here also, when the corpus is contributed, investment is made by trust, income is earned by trust, and distribution is made by trust, what happens under FEMA? That is what we are looking at. Resident discretionary trust to be formed by inward remittance by the non-resident Indian. You all know that if a remittance is made by the non-resident to the trustees of the discretionary trust in India, there is no creation of assets or liabilities in India by the non-resident because he has created an irrevocable trust. And therefore, he does not own any assets in India. And therefore, it is not a capital account transaction. It is a current account transaction. And therefore, there is no FEMA implications. So we are saying when non-resident Indian is settling the trust in India with a direct remittance from outside India, there will not be any difficulty and there is no FEMA implications. 56(2), 47(3), etc. we have already examined. So there are no issues. Now, this same contribution is made from NRA and NRO account from India. You know that when we make payment from NRA and NRO account, it's a capital account transactions. And these capital account transaction rules are covered in FEMA 5R, NRA and NRO scheme. And there is a general permission for local disbursement and local payments. If we treat this not as a gift at all, because it's a settlement, we all know the settlement and gifts are different. We are loosely saying this as a gift, but settlement requires no other person to receive it, where the gift receives 2 persons before giving and after giving. It is between 2 persons. There are no 2 identifiable persons in the case of settlement to the trust, and therefore settlement is quite different than the gift. Then we come to see the FEMA has a different law for transfer of shares, the transfer of money, and transfer of immovable properties. They all are covered in a different provisions of the FEMA. So when a gift, the shares are settled onto the trust, it is a transfer of shares by non-resident India's assets. So therefore, it is a alteration of the assets of the non-resident in India, because their shares were held of an Indian company, which are transferred to the trust. So it's a capital account transaction. And non-debt instrument rules of 2019, that's a earlier notification 20 of FEMA, which is popularly known as FDI regulations, permits such a transfer under regulation 9.2, and therefore this will go through without any problem. Now, gift of a debt instrument. Now, debt instruments are not covered so easily. The changes is not covered in the debt rules, and therefore specific permission will be required. Then immovable properties. Immovable properties, again, it's a non-debt instrument rules starting from regulation 24 to 30. And if it is transferred to the resident beneficiaries, it is permitted. Immovable property is permitted. And if it is transferred to NRI and OCI, it is also permitted. Purely if a beneficiary is a foreign citizen of a non-Indian origin, it will not be permitted. And therefore, this transaction will also go through. Now, investment of trust assets in shares and real estate and derivative contracts by the trustees. There is no alteration of resident assets outside India. That means if the beneficiaries are resident, there is no change in asset outside India. There is no alteration for NRI's assets in India. And therefore, this is a current account transaction, the FEMA, no foreign exchange involved, no FEMA implications while making investments. Now, collection of trust income by resident trustees. Again, no FEMA implications, very self-explanatory. And then distribution and remittance of current income and accumulated income. If you see distribution to NRI beneficiaries from this trust, alteration of NRI's assets in India, answer is yes. Capital account transaction, answer is yes. But there is general permission to credit legitimate dues in the NRO account. So you can deposit the distribution in the NRO account without difficulties. Remittance of current income received by NRI beneficiaries. You know that whether held investment, repatriation or a non-repatriation basis, income can be repatriated of any level and general permission is there. Therefore, remittance of current income received from the trust by the NRI beneficiary can be deposited in an NRO account, but can be remitted also outside India without any difficulties. Similarly, accumulated income, if income cannot be identified to the number of years, then it's a capital. And up to $1 million, you can definitely remit outside India in case of a non-resident beneficiaries. Distribution and remittance of corpus of the trust. Again, same principle applies. 5R and 13R, 1 million, and the general permission to credit legitimate dues in the NRO account. This is just a summary of the entire gamut of the transaction, which you have seen from the perspective of the irrevocable trust and the revocable trust, basically. Because we have looked at determinate and indeterminate, we have not looked at irrevocable and revocable. That also I've covered here, because for the purpose of tax, it was very simple. 1660 to 64 was very simplistically said. And therefore, this is also very handy for you. And it is self-explanatory. I don't want to spend good time unnecessarily, because it is a summary of 78 to here, basically. Now we're coming to the resident Indian wanting to establish an offshore trust. A very interesting situation arises here. If you make direct remittance to settle offshore trust, there is no difficulty because it's a capital account transaction permitted under the LRS scheme. But if you have bank account abroad and if you are transferring from that bank account to an offshore trust, it is alteration of resident assets outside India. Therefore, it's a capital account transaction. FEMA 1 says that it is not a permissible transaction, therefore it is not permitted. So very, very careful. People are doing this right, left, and center. Send it money to the bank, then set up a trust because it is otherwise permitted. But this becomes a capital account transaction not specified in Schedule 1. Loan to resident to offshore trust. Loan by resident to offshore trust. Again, it is a permissible capital account transaction. So it should be permitted under the LRS scheme. So this is about the FEMA implication. I have just summarized this, what I've discussed here, and you can put the answer whenever you want to put, because all the 4 life cycle transactions have been already discussed by us in the slide number 78 to 89. And that is about the FEMA aspect. And this is just a side aspects. And what are the trends currently which is affecting the offshore trust, particularly G20 declaration, the information exchange treaty, role of FTA and TR, number of treaties with the tax havens, and exchange of information article with the number of countries will lead to the situation that whatever information you want to hide or make it opaque will be available to the government of India without any reservation on an automatic basis, most of the information. And one such action which India took with Cyprus was the treaty was suspended because of the exchange of information article was not well behaved by the government of Cyprus. Now, I've just kept one of the TIA, tax related information exchange agreement, for your ready-made reading, but hardly anything is required to be elucidated because you know that information exchange treaty works very well, except in the case of the fishing expeditions. The government of India cannot have a fishing expedition. There must be an income tax proceedings in India or any other proceedings in order to get the information from other countries. And if it's a fishing expedition, the other country may say that this is a fishing expedition. So another important aspect which I want to suggest in the information exchange treaty is that the section 119 onwards, the powers of the assessing officer, tells you that he is authorized to inform the other agencies of the India, other regulatory agencies of India, if any information he finds he can share, and under certain circumstances, he has to compulsorily share. These has been very well objected by the competent authority of the other countries that this can be used only for the tax purposes. Your tax officer can suggest and can transfer this information, and under certain circumstances is obliged to transfer, and therefore unless you have a good data protection policy, we will not give this information. And Indian residents have successfully fought this litigation outside India in order to provide this information by the foreign trustees. So this is what I wanted to say about the tax information exchange treaty. Thank you very much, friends, for patient hearing. And we can now take final question answer on the subject.
Thank you so much, Paresh sir. Paresh sir, can you access the Q&A?
Yes. Yeah. I will just now try and first close this, I think. Yes. Nimish Murali. When applying for PAN as a representative, we covered Hasmukh Thakkar. How to convert private trust into public trust. See, private trust into public trust, don't want to answer you in detail, but you can look at the study of how Escort Hospital has converted into a public trust. And there is a provision under tax law of the conversion of the assets, the accredited asset, 115 scheme of the taxes. 115, I will tell you the section also.
115 TD.
Yes. Under that scheme, you can convert the assets of the private trust into a public trust and public trust into private trust, both, vice versa. Basically, whatever exemption you have taken, how you can chew those exemption without any payment of taxes is a scheme. So probably it's not a forum to answer this question in full, but I am giving you the lead. Anonymous attendee, if charitable trust formed having PAN for the benefit of employee provident fund can be now dissolved or can be changed as AOP? Yes, answer is same. Is there a way for Indian specific trust with US beneficiaries to avoid tax implication in the USA for Indian investment income such as dividend, capital gain? Very interesting question Nimish Unatkat has raised. Nimish, it is a subject by itself. The US do not levy any taxes or any disclosure requirement if it is formed in the form of a grantor trust in India. Grantor trust means revocable trust, which we popularly know in the background of section 60 to 64, 60 to 63. So if you form a revocable trust in some manner, then probably you have the answer. Yeah, that is your answer. Can another trust be one of the beneficiary in a trust? Indian trust law do permits, yes. Then it is only the settler who can settle and contribute assets fund in the trust, or even the beneficiary. This is also answered earlier. Sudhakar, can a non-resident be a settler? What is the view of the registration? We have already answered this question. I think that's all.
That's it, I think, Paresh sir.
Anyone want to raise any question by...
That's it, I guess, Paresh sir.
Yeah, okay.
We have one last question. One last question, Paresh sir.
Yeah, okay. Keshava, my colleague, Indian resident individual is a beneficiary to a foreign trust discretionary, but the individual have no knowledge of the same. If such individual is required to report it in FA schedule, answer is no.
Okay.
Keshava, answer is no.